Hi, good evening. What I want to do is just go over a couple of concepts, just kind of show you what the normal thinking is and the way things have always been done. First of all, thanks for giving me your time and allowing me to share some time with you. It's always better if we share what we know, and if what you are doing is not working, it's always good to try something new or just be introduced to a new concept. Um, right now, I just wanted to go over the basic homes of money. Typically, there are four major areas that you can store your money: real estate, bank, stocks, and this includes your 401k, IRAs, uh, Roth IRAs. It's all the same thing. And then the fourth one here we'll go over here in, later on in just a moment. Now, let me ask you this: if you bought a house today, right, and you put your money in the house, then COVID-19 happens, you're out of work, and you need the money. Would you say the asset is liquid? Would you be able to get your money out today to cover your expenses or to cover an emergency? No. Um, would you say it's safe? I mean, do we know if the value of the house is protected? It could go up, it could go down. Sometimes there's no way to say. So, and then as far as the growth, it's questionable. The value could go up, could go down, just depending on your neighborhood, depending on what's going on with the economy. Now, one good thing is that for your house, you do get a tax write-off, right? Uh, so if we were to grade it up to this point, uh, would say that's what, 1 out of 4. Now, it's been a long time since I've been in school. Would you say that's a good grade or a bad grade? Okay. Now, if you put your money in the bank, if something happened, would you be able to get it out? Would you say it's liquid? Yes, yes. If your bank doesn't give you your money, then you probably need to get a new bank. But for the most part, yes, the bank is money would in there would be pretty liquid. Now, would you say your money is safe in the bank? Is it better off than hiding it under your mattress? Yeah, and it's you know banks are regulated, so it's fairly safe. And what about the growth of your money? Banks and checking accounts and savings accounts are known to have this awesome phenomenal interest rate, right? No. Yeah. Yeah, you don't get any growth when you put your money in there. Now, does it get taxed? That's a good thing, so we'll give it a plus. So here, what grade would we give it? Would give that at this point 3 out of 4. Not bad. Kind of okay. Now, another place we all put our money in is the stock markets. Like I said, that includes 401ks, Roth IRAs, Seth IRAs, all kinds of investment programs tied to the stock market and the performance of the stock market. Uh, if I put money in my 401k, would you say it's liquid? No. And remember here, liquid, what we're talking about is you can get it with no stipulations. Because usually you can borrow from yourself and get money out of your 401k, but then you have to follow certain rules. You have to sign paperwork saying that it's a loan and you have to pay it back with interest. So I would say it is not liquid. Is it safe? Again, does the stock market go up and down? I would say yes. So it wouldn't typically say that it's safe. All these investments come with warnings that you could lose all or part of your investment. Growth, again, the growth is questionable. Has the stock market been hit now and then? Definitely. Did COVID-19 take a big chunk out of most people's retirements? Yes. Now, when you're closer to retirement, obviously that makes the biggest impact. Now, as far as taxes, the way stocks work and your 401 especially, you are taxed later. right? Let me ask you this: if I gave you stock in Apple 10 years ago versus today, would you want to pay taxes on the stock 10 years ago or today? That's right, today. Because you want to pay it when the seed is small, when the investment is still small. So another big issue with the stocks is that you get taxed later, which your nest egg is even bigger. So out of that one, I would give that, a 0 out of 4 rating, right? Now, there's one, to get to this last column here, I want to go over a couple things that are needed for all these other homes of money. When you buy a home, the bank requires you to get what? What I was looking for is insurance. You have to insure the home to protect it against, damage, or anything happens to it. You got to get insurance. And when you put your money in the banks are usually FDIC insured. So they also have to get insurance. And any stockbroker, any financial advisor, they're required to have insurance in case you sue them, and which that insurance is tied to a license. So again, even this has to be insured. And which just brings us to the fourth home, and most of the time the least used home of money, which is life insurance. Okay, now there are products with life insurance where you can put the money in and you can get the money out for any reason. It's your money. You can always take out the cash value. So it is liquid. Is it safe? Again, this is insurance, so it is regulated, and it is controlled, and the insurance companies are required to have certain reserves to be able to cover losses. So I would say that's pretty safe. As far as growth, the investment part of the life insurance policies is tied to the S&P. The S&P is, an index that matches the best performing companies, right? So we would say it's you'd get some growth, and then as far as taxes, it's tax free. The payouts on the insurance will not be taxed. And then one thing I also wanted to just go over, so we would give that 4 out of 4, right? Think back to all the events that have happened. Has the real estate market ever collapsed? 2008, 2009, correct. Have you ever heard of a bank collapsing? Lehman Brothers, for example. All right. Stocks, has there been a crash in the stock market? Yes. Now, have you ever heard of a life insurance catastrophe where the life insurance companies have run out of money? No, this industry has been existing for years and years and centuries. Now, the critical part that I wanted to explain is that you notice the grading on these places of keeping money. So then what's interesting is that society, school, human psychology, programming, we have all been programmed to put the money in the worst places or in the wrong order. Let me show you how. Let me show you what I mean. I was, told through, growing up sources, you want to get a job so you can have money, so you can have money to save, money to put away, and then eventually you will retire. So the first place in this arrangement is to put your money in a job, and then as soon as you get the job, when you get your paycheck, what's the first thing you see? There was a deduction, and they put money in the stock market. So you started with bank, then you put money in the stock market, and then you work a couple of years, you build up your 401k, and if you're like I did, you took money out of your 401k to put a down payment for real estate, for your home. And then with the real estate, if there's as I get older, there's some money left over. I start to see, oh, what's around the corner. There might be some exposure to probability of death, and they're not squeezing some life insurance without my job, and most of the times, even this one at your job is they'll have it 2 times or 3 times your salary, right? Uh, One of my first jobs working corporate was 28,000. So 2 times as higher would have been 50,000, or even at 100,000 would have been 200,000. Now, with this kind of life insurance, if something did happen to me and I got 200,000, it's not even enough to pay off a house in these modern times in Collin County or wherever you might be. So hopefully you see the problem there. So we start with job or bank, which the current situation starts with that. Then it immediately goes to the worst home where you can put your money. Then after that, it goes to the second worst place you can put your money. Then finally, if there's some left over, or your job offers you life insurance, which, by the way, would you agree if you got fired, you lose that coverage? Do a lot of people get fired? Sure they do. Now, let me show you what we should be doing, what they should teach in school, what you should teach your kids too. And as soon as I learned this, I taught it to my kids. What you want to do is flip this over so you can have a strong base, right? So the right way to do it, according to this, would be very first thing you do is put money into life insurance. Because out of these, right, which one has 100% chance of happening? Death, right? I mean, we don't want to sometimes face that reality, but death has 100% chance of occurring. So if you have something that has a likely chance of occurring versus something that has 100% chance of happening, where would you say you'd want to make the priority to address? Right. The one that has a high probability of happening. And, things like death, would you say deaths affect family members? They affect your family, they affect your dependents? Yes, definitely it does. Especially, if you're the breadwinner, or even husband and wife, you're both the breadwinners, something was happened to you, it would put an enormous strain on your family, right? Not to mention your friends and relatives, to try and take care of your, final expenses. So where we want to start is, first of all, put money in life insurance. And then we want to put money in the bank because, you could have emergencies, and this is like reserves. You need to have an emergency fund because things do go wrong. Your car breaks down, a trip to the emergency room, you definitely want to have that. Then from this, the very next thing should be to invest in real estate. And then finally, then stocks and 401ks in that order, because as there's always times when the money doesn't make it all through all your all the money that's your bills or things that need to be covered. It doesn't make it all the way. So it is the smarter way. And the way that the wealthy have taught all their kids, they have taught generation after generation after generation, they have taught them to set them up this way. So if this, not a matter of if, but when this happens, then you're taken care of. And here's the other reason you want to start earlier with, as far as life insurance. Would you say life insurance is cheaper when you're younger or when you're older? Yes, definitely when you're younger. So if you wait in this plan, right, 2 years, 5 years, 10 years, that could end up costing you a lot more money than it would have costed you, let's say, if you got it 10 years before that. And so then, therefore, that begs the question, even for children, so when would you get insurance for a child? As soon as you have this information, correct. Let me make another case for life insurance. We know the very first thing that it covers is death, right? How are we doing on time? I was trying to keep it under 15 minutes. Okay, so we have products that cover death, that cover long-term care. What's the probability that, a stroke or an accident at work could make you disabled and not able to work? There's products that cover that. And because a market crash has a probability of happening, then you need products that are tied to the S&P or the best performing average of the stock market. And with that, would you say you're ready to look at a couple of options to get your family protected? Okay, let's do it.